Good evening, participants. Welcome to today's webinar on Market Insight for Fixed Income, where we discuss key updates related to bond market and economy and our outlook. I am Sonal Mittal, Product Specialist at UTI Mutual Fund, and your host for this webinar. And I'm joined by our Head of Fixed Income, Mr. Anurag Mittal, to share his insights, perspectives, and outlook on bond market. Post remarks from Anurag, we will take up question and answers. Please note, you can post your questions anytime during this webinar on the link provided to you. Without further ado, I will now hand over to Anurag. Over to you.
Good day, participants, and thanks a lot for joining in on UTI's fixed income webinar for the month of August. It was a very eventful month, both in global as well as domestic markets. In the early part of the August, we had a significant yen appreciation movement, which led to a lot of volatility in both currency and fixed income markets, which in normal parlance is called the unwind of yen carry trades, which was basically borrowing in yen and investing in foreign currency. And when that got unwound, as Bank of Japan decided to hike rates more than which was market expectations, we saw Japanese 10-year bonds going from 1% to 0.75 in just one day. The volatility index on S&P 500, commonly known as VIX, saw its biggest percentage day increase on 5th August in its history. Of course, as markets settled, the yen went from USD JPY level of 160 oddish to 144. Markets started to settle. The Bank of Japan made conciliatory noises that they are not likely to hike at any level, and they will be looking at market stability as well. Gave that stability to both currency and fixed income markets. We also had the release of the FOMC minutes, which was conducted on 30th and 31st of July, where majority of the participants opined that the time had come in September to cut policy rates. So that's one of the key variables that the whole global bond market was waiting for, that the anchor central bank or the Federal Reserve, once they start to cut rates, other central banks can also follow suit, as typically if the other central banks were to preempt or start cutting before the US Federal Reserve, that could have resulted in more volatility in their currencies. And most importantly, market participants were also waiting for Chairman Jay Powell to give his speech in Jackson Hole. It's the annual central bank symposium which happens, and typically, Chairman Powell has shared his thoughts on the upcoming, Federal Reserve policy and thinking. And although it was not as emphatic as whatever it takes by Mario Draghi of ECB, the famous words which the whole market was waiting for at Jackson Hole came from Chairman Jay Powell, who said that the time has come for policy to adjust. We do not seek or welcome further cooling in labor market conditions, which was taken quite positively by the market, and which was also as a precursor to easing by the Federal Reserve. Now, probably the bigger aspect that the bond market would be tracking is whether the Federal Reserve in September cuts by 25 or 50. We will discuss that in detail as we go through our presentation. First, we'll be sharing our global, thoughts on how the global markets are panning out, and then we'll move on to the domestic market. So if we look at the manufacturing and services PMI, it's slowing down, but it looks quite stable, considering that since 2021-22, both manufacturing and services have largely been in an uptrend. So it's largely, they are stabilizing around 50 levels, but nothing materially concerning as far as a major slowdown is concerned. If you look at the chart on the right-hand side, which depicts the industrial production in the advanced economies as well as in the emerging economies, we can see that after bottoming out in 2023 and even the YOY numbers are looking quite healthy. So, of course, right now the global consumer spending looks quite stable. The labor market is slowing down, but if you look at the wage growth, it's still following up, it's higher than the pre-pandemic growth trend rate. So broadly, your growth is still quite stable, quite impactful. So hence, there is a risk of downside surprise in economic activity, because one of the views that the market participants have made so far, that probably we are heading towards a soft landing, which broadly means that inflation will move around its 2% target and growth will slow down, but we are unlikely to see a hard recession. So that's our base case as well, because, like we said, we are not really seeing any distress in labor market, consumer spending, or financial markets. But we will be watchful that how this trend further pans out, given the very aggressive rate hikes. There is still some scope for some imbalance to come out in some way, as we saw in the regional banking crisis in 2023. So while majority of the view is that we are heading towards a soft landing, but nevertheless we have to closely watch the labor market to really assess that whether there is any sign of any significant distress. If you look at the commodity as well as the food index, so if you look at the commodity prices on the left hand side, they continue to decline, and compared to July, they sequentially declined as market participants remain concerned on global growth. If you look at the Chinese GDP for Q2, that also disappointed compared to expectations. If we look at growth in Eurozone, that's also slowing down, and there are fears that US economic growth has also started to slow down. So that concerns kept most of the commodity prices in check. Notably, copper, nickel, and other industrial metals continue to fall. If we look at crude, in fact, crude now is trading approximately around $75 a barrel. So it's given up all the gains, or in fact, it's trading lower than the beginning of the year, when market was expecting a major slowdown and they were expecting 150 basis points of rate cut by the Federal Reserve. At that point of time, crude was trading around $80. So it's even trading lower than that, which goes to show you that probably market participants are concerned about growth. So as most of the industrial metals and oil prices fell, expectations of more aggressive easing by central banks increased. The lone commodity which did well was gold, which continues to do well, as expectations of easier monetary policy, a looser liquidity scenario comes into play. Gold has continued to do well. If you look at the right hand side of the chart, which is the food price index, that continues to be stable, as overall the heat wave that we saw in May, that continues to de-intensify, and overall the monsoon has been quite favorable, and which has kept food prices in check. We continue to expect food prices to remain well in range, as weather continues to be overall favorable going ahead as well. If we look at inflation, and if you compare it to whether peak inflation or inflation in last 3 months, overall the trend has been quite clear. Inflation for most of the major economies has been slowing down. It's moving towards the 2% target. And where is this disinflation coming from? So for the last whole year, if we see, we have seen massive correction in goods prices. We have seen goods disinflation. But as you were talking about, wage prices continue to be sticky, and hence service inflation still continues to be stable. It continues to be above its pre-pandemic trend, and hence we believe that the pace of disinflation could be slightly gradual. It could remain sticky for a while, which broadly calls for a calibrated rate cut cycle than a very aggressive rate cuts. So that's something which bond market participants and market participants have to watch out for. That as central banks are looking to rebuild their credibility, are looking to ensure that inflation expectations firmly align around 2% target, they may not cut interest rates in any knee-jerk manner, but in a more gradual and calibrated manner as till they see a great financial market or a labor market shock, or till they see a sustainable decline in service inflation. If you look at the 10-year sovereign benchmark yields, so broadly we are back to where we started. So if you look at the US 10-year closely, we started the year with 3.91% 10-year bond yield in January 24. If you look at August 24, after doing a whole seesaw movement, 10-year yield is back to trading at 3.9%. Mind you, at the beginning of the year, market participants were expecting about 6 rate cuts from the Federal Reserve. It was widely expected that the whole global economy will undergo a slowdown. So we are largely now back to those valuations where now market participants have greater confidence that the Federal Reserve will indeed start to cut its policy rates. The same has been affirmed by the FOMC policy minutes as well as by the Fed chair in various public interactions. So, of course, there is a bigger visibility. The only question is whether the Fed will cut rates in the same intensity as market participants are expecting. But broadly, what we see across the world is strong comfort from market participants after there is a higher visibility on Federal Reserve monetary easing, and we see broadly most of the markets we have seen decline in benchmark bond yields across Asia, Europe, etc. So if you look at on the left-hand side, which is financial conditions, the financial conditions which had tightened in May and June, and as we saw in the previous slide, this was a time when the 10-year bond yields in the US were trading around 4.5. So as the bond yields have come down, the financial conditions have also turned loose as now market participants are repricing their interest rate forecast. So the same we can see is reflected in the market implied policy rates through interest rate swaps. So if you see at this the right hand side chart during the month of May and June, at that point of time market participants were expecting around 50 basis of rate cuts. So if you see it's closing the indication somewhere around June is that market participants were expecting around 5% policy rate after a year, which basically implied a 50 basis cut. But if you look at today market participants are kind of pricing in at least 100 basis rate cut today. So it's quite interesting in a way that if you look at in 2024 there are only 3 policies which the Fed is supposed to have. So at least in one of the FOMC meetings, Fed needs to cut at least by 50 basis to meet market expectations. And probably there is still a high bar for Federal Reserve to cut by 50 basis. So while we do expect Federal Reserve to cut by 25 basis, we believe that probably it will take a major data point like either inflation or unemployment rate for Federal Reserve to cut by 50 basis. So probably financial conditions could remain slightly volatile. These policy rate, implied rates could again see some volatility depending on how data turns during the next 1 month for the global economy. Coming to India, if you look at inflation, there was a substantial drop in headline CPI from 5.1% to 3.54% in the month of July. It was lower than consensus estimate, which was expecting around 3.6% headline CPI. One of the reasons for this substantial fall is the very favorable base effect. So if we see last year, July 23 inflation, which came at 7.44% compared to 4.87% in June, there was a substantial pickup in vegetable prices last year. And because of this base effect, it was widely expected that inflation will indeed show a fall in the month of July. So as we can see, RBI has also projected inflation of 4.4% in Q2 FY25 estimate. But the fall was much larger than expected, as even the increase in vegetables was not as high as it was feared. And if you look at the current, concurrent indicators on vegetables as well as cereal prices, it's actually turning to be quite favorable for the month of August as well, the data for which is supposed to be released in September. So we do expect this, 4.4% estimate of RBI could be, we could see some revision in the upcoming policy in the month of October, as we think the next two readings can also come meaningfully below RBI's estimate, given the sharp pickup in monsoon, given the correction in vegetable and cereal prices. Now, one of the features of this inflation data was pickup in core inflation due to the one-off hike in telecom tariffs. As we know, most of the telecom companies conducted a 20-30% tariff hikes in the month of June and July, which is reflecting in the core CPI pickup. Typically, central banks tend to look through one-off price shocks as long as they are not impacting headline inflation or inflation expectations on a more durable level. So we do expect that probably core inflation has bottomed out. Going forward as well, core inflation could remain slightly high, but we should see that being offset by the drop in food inflation. Hence, we expect overall headline inflation to come slightly below RBI's projections, which do open up some space for RBI for rate cuts. If you look at why we are confident on food prices going down, if you look at the distribution of monsoon, there was a expectation, or there was a fear in the month of June when monsoon was slightly below, that probably again, if the monsoon were to be weak in this year 2024, then probably we'll again see a pickup in food inflation, and probably RBI will have to remain slightly hawkishly biased as it tries to anchor inflation expectations. But if we look at the rainfall data, barring East India, largely, in fact, rainfall has been excess than normal. If you look at the sowing data, especially paddy and pulses, which have a large impact on food inflation and as well as inflation expectations, sowing has been better in 2024 compared to 2023. So overall, it bodes well for food prices going ahead. This kind of excess rainfall is also helpful for winter crops or rabi crops, as it gives extra moisture to the soil, and hence at the time of sowing of rabi crops, farmers are not really dependent on monsoon at that point of time. This does provide that helpful benefit, and that's why we are slightly constructive on the drop in food inflation. We believe that RBI will also take comfort from this healthy distribution of rainfall. The GDP data for Q1 FY25 was released, and as we can see, it fell to 6.7% from 7.8% in Q4 FY24 and from 8.2% in Q1 FY24. So while market participants could be concerned on the drop, but if you look at the internals of GDP, it's actually quite favorable. So if you look at the private final consumption, which is typically 55 to 60% of our economy, that actually picked up. So if you look at 7.4% of private final consumption, this is actually quite promising, and it means that the consumption, which has been a key concern for many policymakers, it means that it's picking up. And as monsoon distribution has also been going quite strong, this is also quite constructive for rural spending going ahead as well. So overall, we do expect consumption to remain quite healthy in the upcoming quarters as well. If you look at the high frequency indicators such as two-wheeler sales, rural credit, the demand under NREGA, these high frequency indicators are also pointing towards a healthy consumption expenditure going ahead as well. If you look at the most of the drop is largely coming on the back of government final consumption expenditure, which was expected due to the code of conduct during general elections by both center and state. So we do expect that once as the code of conduct has been over, government spending is coming back, we do expect even the government expenditure to come back and GDP growth to pick up. But if you look at GVA, which is also a very good indicator, and in fact, in many cases, a better indicator of growth, because ultimately GVA plus net indirect taxes is equivalent to GDP. So it's largely about net subsidies. If you subtract from GVA, which takes you to GDP, so GVA in a way reflects the true underlying activity. So if you look at the internals of GVA as well, they look quite healthy. As we can see, electricity production went from 7.7% in Q4 to 10.4% in Q1 FY25. Construction services went from 8.7% in Q4 FY24 to 10.5% in Q1 FY25. You look at real estate, trade, and even public administration, the spending has been quite healthy. So overall, we are looking at a healthy scenario and a more secular growth coming up for FY25, which should give a lot of comfort to RBI as well, as it looks towards maintaining the inflation growth dynamics. If you look at system liquidity, it's been consistently positive. In fact, uh, because of the government spending and currency in the banking system now coming back, which we had expected. As we can see in the chart, the MIBOR rate has been now closed largely following the policy rate. So while I would say money market rates have not come down because CD issuances as well as CP issuances have been quite high, but nevertheless, the system liquidity, which was a major issue, especially in the month of April to June because of lower government spending, that has been addressed, and we continue to expect that system liquidity will remain smooth. You may have some temporary mismatches during the advance tax outflow during 15th of September, but broadly we do expect liquidity to remain comfortable in the upcoming months as well. Money market rates may be more influenced by the issuance pressure rather than just broad headline system liquidity. If you look at credit and deposit growth, so we're talking about money market rates, and the gap between credit and deposit has a major bearing on how money market rates or even the short-term bond rates pan out. And if you look at non-food credit, it is continuing to moderate as the measures introduced by RBI since last year, especially on the unsecured lending, are now bearing fruit. So non-food credit has moderated to 14.8% YOY versus 15.1% YOY in July 24. If you look at the breakup of or the sectoral deployment of credit, although it looks like that retail loans they grew at 17.8% in July versus 16.6% in YOY in June 24, we have to be mindful that the June 24 period this year was again impacted by a large base effect in June 23, and that's why the growth rate in June is slightly lower. But if you look at the overall month-on-month absolute numbers, it is pointing towards moderation, which is reflecting that the measures taken by RBI are now being effective, and probably it overall bodes well for financial stability. If you look at unsecured loans as well, again, although optically they look higher than June, but month-on-month there is a visible slowdown in unsecured loans as well. If you look at the fiscal trend, so the courtesy, the code of conduct during general elections, the fiscal numbers have been quite healthy so far. If you look at the April to July 2025 fiscal deficit, it was just 17% of FY25 budgeted estimates and the lowest in 2 decades. If you look at revenue collection, especially income tax, it's extremely healthy. So if you look at corporate, income tax and others, they actually went up by 56% FITD April to July. 4.14 trillion compared to 2.6 trillion. If you look at corporation tax, that's growing at a moderate pace, but the income tax collection is really outperforming the budgeted estimates. If you look at the non-tax revenues, they were also up 3.3 trillion compared to 1.8 trillion, which was largely due to RBI dividend. If you look at the on the expenditure side, as we can see, while the revenue expenditure is largely in line with last year, the capital expenditure is meaningfully lower by 18%. We do expect that capital expenditure to pick up. One of the reasons for the drop in capital expenditure, like we discussed in the previous slide, was the code of conduct by the government. And as that code of conduct has ended, government spending has started to pick up. We do expect government to meet its capex targets for the fiscal year 2025, and we do expect that government would largely meet its 4.9% fiscal deficit target. If you look at on the trade deficit side, uh, although it was adversely affected due to some slowdown in non-oil commodity exports, but overall it still remains quite controllable. As you can see, the net service exports continue to be quite stable. Hence, we do expect CAD may widen compared to FY24, but it will still remain manageable somewhere close to 1 to 1.5% of GDP, and which is sufficiently managed by our long-term flows both on FDI and FPI. If you look at the shape of the curve, as we can see in the month of August, as we saw during global bond yields also going down, there was largely a secular down move across the curve, where yields across the curve fell compared to previous month. If you look at the rating distribution side or the sovereign distribution side across T-bill, AAA, AA, etc., we saw sharp fall in bond yields compared to the previous month. As the global cues became more constructive, there is more stronger visibility of interest rates cuts in the US, and as a result, bond yields fell across. If you look at even the 3 and the 5 year rates, whether it's government bonds or AAA levels, they also came down, as market participants are now pricing in rate cuts from the RBI, probably from December onwards. So broadly on the outlook, if we look at what really, and to summarize where the macro construct right now stands, one of the key concerns of the central bank or the RBI has been high food inflation, has been very volatile food inflation, which is making their jobs slightly difficult, because of which they've had to keep rates slightly on the higher side. But if you look at the trend of food inflation, now it started to cool down thanks to a normal monsoon. If you look at core inflation, although it's bottomed out, it started to go up, but nevertheless, given the slowdown in goods, inflation, we do expect core inflation to remain quite benign and to remain range bound. If you look at the global growth momentum, that's moderating at the margin and that's slowing down. And especially on the inflation side, things are now beginning to look very much in control, at least globally. And hence, most of the major global central banks have started to cut interest rates. So as the global plus domestic macro construct becomes more favorable, we are expecting 50 to 75 basis of rate cuts in FY25. So one of the features when we saw the yield curve, of the August 2024, largely we saw a very flat yield curve. So what it means, as we see, 50 to 75 basis of rate cuts, broadly we expect yield curve to steepen. And why do we expect yield curve to steepen? So typically what happens as a precursor to, fall in interest rates, typically at that point of time, market participants usually tend to increase their duration. They prefer to be in the highest duration segment as they're anticipating, cuts in interest rates. But as we get closer to the interest rate cuts, it's typically the short end, which is anchored to the overnight rates, that tends to typically come down quite sharply, and that's why yield curve usually steepens in a rate cutting cycle. And not only we expect the 50 to 75 basis of rate cuts to help the curve steepen, we also expect, if you look at liquidity. So if you see in the last 6 months, especially in the month of April to June, liquidity was quite tight because of lack of government spending, and that's why the short end was not really performing as compared to the long end. But now, as we expect liquidity to remain easier, we expect credit growth to moderate from these levels. We do expect short end to also outperform the long end. One of the other reasons why we expect yield curve to steepen is you have a heavier H2 supply calendar in government bonds as well as SDL. So typically, SDLs have a light calendar in the H1, and typically there is higher issuance in H2. And in this year, uniquely, the government bond calendar was lighter in H1, and hence we do expect the higher supply in H2 to keep yields at the long end slightly elevated compared to the short end. The third aspect is, as we have discussed before, India is now part of JP Morgan bond index. So as we expect more flows in Indian fixed income because of the index inclusion, typically the preferred duration segment for foreign portfolio investors globally is the 5 to 10 year segment. And that's why, because of the favorable demand supply balance there, we do expect short end rates to also do well. Of course, we discussed that there is a clearer visibility of monetary easing. So as we go closer to the rate cut cycle, short end rates can outperform the long end. And hence, in this kind of a scenario, we think the moderate duration products, or basically products which are typically running duration up to 4 years, they provide the probably a better risk reward in this scenario for shallow rate cut cycle. If you look at the real bond yields today, so if you consider forward-looking inflation or average FY25 inflation, which is at 4.5%, and if you look at 3-year AAA bonds, which are trading around 7.5%, you're looking at a 300 basis points real rate. So this kind of real rate, Indian investors or fixed income investors are seeing after a long time, which we think is quite attractive, as it gives you a reasonable accrual, as well as it gives you a possibility of participating in capital gains as the rate cycle turns. So which products are suitable for investors also depends on your time frame. So if your time frame is 6 to 12 months, then probably products like ultra short term money market or low duration are more suitable, because that's largely the duration that those products maintain. If investors have a more than 12-month investment horizon and appetite for mark to market volatility, probably they can consider 1 year plus duration to 4 year duration categories, such as short term bond fund or a corporate bond fund, which can give them a reasonable accrual as well as a higher duration upside. So that was largely from my side. Happy to take questions on any of the slides that we presented, or any other questions that you may have. Thank you.
Thank you, Anurag, for your insightful presentation. The webinar is now open for Q&A. Like I said, you can share your questions on the link provided to you already. While we wait for the questions to queue up, let me begin with the question that we have already received. The first question goes like, with the inclusion in JP Morgan Index, volumes in the highly liquid 10-year benchmark GSEC have predictably increased. What's distinguishing in the current spate of foreign inflows from the other episodes of global investments is a higher degree of transactions in the traditionally off-the-run illiquid securities. What could be driving this?
So I think the volumes in the government bond market have always been quite high. And in fact, I would say that it's been the other way, where volumes, at least in the last 1.5 months, have slowed down. compared to if you look at the typical trends in the government bond market. Nevertheless, what's driving the behavior or how it is different from typical allocations that India sees in fixed income is at this time, investors have a compulsion, at least investors who are tracking the JP Morgan index have some compulsion to invest in Indian government bonds. And hence, they are looking at India very seriously. We've already seen more than $13 billion of inflows coming up into Indian bonds since the announcement of JP Morgan bond index. And we do expect the flows to continue, but we do not think that probably suddenly volumes will pick up because of the bond index inclusion, because typically these investors, they don't invest tactically, they don't trade, and which is in fact better for Indian fixed income long-term investors. They typically track the index and they stay invested for a long time unless and until their view changes or there's a rebalancing of the index. So the good thing about inclusion of the index is that we are attracting long-term money, we are attracting more sticky money compared to the previous, and that's also reflecting in the trading volumes.
Sure. The next question is, the RBI has kept highlighting concerns over inflation. While we can read in the prints of the MPC minutes, two of the external members of MPC voted to cut the repo rate with a belief on receding inflation threats. And they expressed that excess monetary tightening could trigger a switch to a lower growth path. Do you suggest that it is now the time for RBI to err on the side of inflation?
Right. So, at least we agree with RBI's internal members. We were not really expecting a rate cut in the previous policy because, like RBI governor rightly said, there is a considerable volatility in food price inflation due to the extreme weather events. And for a central bank, when they are, starting to cut down interest rates, unlike market participants, they cannot keep on changing positions. So they have to be one very sure of stability in inflation, which they are yet not finding, which I think, given the considerable uncertainty on monsoon, probably 1 month back or 2 months back, it was more prudent to wait for trends to play out, food price to stabilize, inflation to stabilize, and then to act. The second part of I think the concern was on the growth. At least at this point of time, we are not really seeing any major slowdown in Indian growth dynamics. So probably I think that is why RBI was not really in a hurry to cut interest rates, which we broadly also agree, and that's why we were not really positioned for a rate cut in the August 24 MPC policy.
Sure. Thanks, Anurag. The next question is, RBI Governor Shaktikant Das has been quite vocal about credit growth and disequilibrium in the bank's loan to deposit ratio. What, in your view, would happen if the policy is eased at this juncture with the talks of easing around the corner? Would that heat up the financial system and economy?
So I think this equilibrium between loan and deposit growth is also a function of lower deposit rates. It's also a function of a very high credit growth, which banks are right now pursuing, especially in the unsecured loan space. So if you look at the commentary from RBI or the regulatory action from RBI, most of the concerns that RBI has raised is towards banks' aggressive lending into the unsecured loan space, where it's very difficult to assess the end use and sustainability of those loans. And if you see in the last 6 months, RBI has increased the risk weights, of loans given to these purposes. and to even NBFCs who are engaging in personal loans. So we think RBI is rightfully using the macro prudential tools, which it has used them in the past as well. So we think that probably once loan growth starts to moderate, probably deposit rates may stabilize. On whether the monetary easing may lead to stability or heating up of financial markets. So we are not really seeing a very aggressive rate cut cycle. We are looking at a very shallow rate cut cycle. Some of it's already priced in by the market. So we are not really seeing any major loosening of financial conditions that technically. What's really happening where RBI is perturbed is about very strong growth is on the unsecured loan space. Probably there is not much literature right now to really assess or correlate the impact of easier or lower rates to high credit growth in India at least. So we still think that the right measure to moderate loan growth towards these unsecured space is more macro prudential norms, which RBI has been coming out with, rather than just looking at interest rates.
Yeah, thanks, Anurag. The next question is, you have been consistent on your expectations of a shallow rate cut cycle. So, in this regard, what's your view on the 10-year benchmark G6 yield driving in this year?
See, in the near term, the the valuation of especially the benchmark bonds are a function of interest rate expectations, are a function of liquidity, are a function of global interest rates, and how those expectations are performing as compared to the consensus expectations. So if you look at the 10-year valuation today, it's trading somewhere around 6.85%. If you look at the swap curve, it's pricing in about a 50 basis rate cut from RBI more realistically. So we think probably if RBI were to cut 50 basis rates in the next 6 to 9 months, the 10-year may go down by 10 to 15 basis points if you look at the long period average. While in the very near term, it may go down slightly even more, but from a steady state perspective, that's largely where we expect 10-year to stabilize at. In the near term, if let's say global bond conditions are more benign, probably the 10-year again in the short term could be slightly more volatile on both the sides. But if you look at the long period averages, if you look at the typical term premia in Indian bond market, given the supply, etc., we think that 70 to 80 basis points is a fair spread between 10-year and overnight rate.
The next question is, are there early signs of private capex pickup or not? The bulk of heavy lifting for now has been done by public infrastructure spends. Are there any signs that you would point out for a revival of the private capex as well?
So, while it's true that the balance sheets of private sector is much more healthy compared to the pre-COVID era, if you look at the profitability of private sector, is much more healthy compared to pre-COVID, as the economy has formalized and it's moved towards more organized sector. Um, Nevertheless, we are still yet to see any meaningful green shoots emerging in the private sector capex side, despite now capacity utilization going closer to the historically high levels. While there is some capex happening on the renewable space, on the road sector space, but we are really not seeing any major capex happening across the board, right now compared to what we have seen historically. So I think the jury is still out, and I think we are still yet to see meaningful pickup in the private sector capex. It does not depend on interest rates alone. It does not depend on tax rates alone. It also depends on final end demand. So, one of the charts that we saw was of the private final consumption expenditure picking up in this quarter compared to the last 5 quarters. So if this trend continues, and hopefully even rural spending will pick up post a normal monsoon. So probably if the consumption continues the same trend as we are seeing in the last 3 to 4 months, probably we may see some amount of private sector capex happening in the second half of the fiscal year 2025.
Well, uh, India's GDP slowed to a five-quarter low of 6.7%. Uh, no, in April to June this fiscal, against 8.2% a year ago. Does economic landscape of India remain promising, and is target RBI target of GDP growth of 7.2% for FY25 seems achievable?
So that's the RBI projection. RBI cannot target GDP growth; it usually targets inflation. And if you look at the World Bank and IMF, they're also right now projecting a 7% kind of growth for India. So some of the fall in the GDP that we saw to 6.7% was expected because of slowdown in government spending. So as we know that there is a model code of conduct, and as because this was a very unique election period where it was spread over a period of 2 months, in a way the government spending came to a standstill during those 2 months, and we saw a sharp reduction, hence in the government spending led GDP segment. But broadly, if you look at the internals of GDP, where whether you look at net exports, whether you look at private sector investment, or whether you look at private consumption, that was quite healthy. If you look at sectoral composition of GDP, which is GBA, whether you look at real estate, whether you look at public administration, whether you look at manufacturing, electricity production, all of those internals were looking quite healthy compared to last quarter or compared to the first quarter of FY24. So broadly, we don't think it's we should start worrying right now. GDP looks quite trend. While it's true that the full GDP growth number for FY25 may be slightly lower than RBI's estimate of 7.2%, but we do not think that there is a change in growth landscape for India. We think even a 6.5% plus growth for India compared to where the rest of the world is growing at is quite healthy.
Sure. The next question goes like, we saw Bank of Japan hiking its policy rates again by 25 basis points, even after relaxing economic data points. What are we expecting from the Fed in the upcoming policy? Do we expect the rate cut cycle to begin?
Yes, I think it has been made abundantly clear by the Fed chair in the Jackson Hole symposium, as well as if we look at the minutes, where majority of the members have expressed that they are looking to cut interest rates in September. So we are expecting rate cuts in September. Probably the only question before the market is whether it's a 25 basis cut or a 50 basis cut. Probably a 25 basis cut will be a slight short-term disappointment to the bond market, where they may feel that Fed is more confident on growth, and probably it's likely to tread more cautiously. So some expectations could get reset, but a 50 basis rate cut may encourage bond market participants to pursue or to at least project a more aggressive rate cut cycle, than what right now Fed is projecting. So I think in a nutshell, we do expect a rate cut in September. I think that's not the question anymore that market participants are looking for. I think the question is whether it's 25 or 50, and what are the kind of rate cuts the Fed is projecting in 2025 as well.
In the interest of time, I will take 2 or 3 more questions. Sorry for the interruption. Oil prices have been under pressure due to already factored in production cuts and increased US oil production. Weak manufacturing data from China and a softening US economy have also contributed to this decline. What does it speak of health of the global economy? How is this slump in oil likely to impact Indian economy?
I think overall, lower oil prices are always helpful for Indian economy because about our 25% of our imports come from oil. So overall, I would say it's overall constructive for our current account and for our currency as well. One of the possible reasons for the oil price decline, like you said, is changing outlook on global growth and continued disappointment on Chinese growth data as well. So, as you know, the market participants are seeing that global growth is moderating more than what probably they had factored in a couple of months back. Also, some of the production cuts which the market participants were envisaging, such as Libya, etc., they're not really materialized, and hence, we are seeing pickup in oil production, hence the fall in oil prices. While OPEC has always has an option to curtail its production further, so you cannot really say that these oil prices will sustain going ahead as well. But I think the fall in oil prices is broadly, pointing towards that. Yes, there is a acknowledgement that global economy is slowing. There will be lower demand. It's not just manifesting in oil, it's also manifesting in copper, it's manifesting in iron ore, it's manifesting in nickel. So all across the commodities, we are seeing some slowdown in pricing, which broadly a reflection of market participants' view of slowdown in global growth.
Thank you, Anurag. I'll take this last question. Actually, I'll club two questions in one. Uh, do you think it is time for investors? It is still a good time to invest in long duration funds? And the second question is, can you please explain why you prefer short duration bond funds for investors having an investment horizon of more than 12 months?
So for the question, so we do recommend long duration for investors who want to stay invested in fixed income over a long period of horizon, and they are looking at fixed income as an asset allocation. If you look at the valuation of the long bonds today, a lot of monetary easing is priced in. A favorable demand supply probably is priced in. So we do not really recommend investors to look at these categories as tactical calls, but from a long term perspective to to kind of provide a buffer to their portfolio. So a lot of investors have invested in equity, real estate, gold over the course of last 3 to 4 years. So we believe that fixed income can provide that buffer for investors' portfolio and can provide that stability in investors' portfolio in times of market volatility. And hence, we recommend long duration investors who are for investors who are looking at fixed income allocation for, let's say, more than 3 to 5 years, and who are not perturbed about daily mark to market volatility in their portfolio. For investors who are largely looking at fixed income as a replacement for their fixed deposits, or who are largely looking to invest in a relatively stable asset class or a liquid asset class such as fixed income from a more than 12 months perspective, they need to be invested in segments, one, which have lower mark to market volatility and have more predictability. So from both from a liquidity, predictability, and lower volatility perspective, we believe that moderate duration products even from a long period of horizon, they offer a better risk reward. So if you look at their accrual, with bonds trading at 7.5 plus, one, they provide investors a decent accrual. Plus, they also provide investors with some opportunity of participating in capital gains. The third thing which we want to highlight is that interest rate cycles, as we have learned in the last 12 to 24 months, can be slightly unpredictable. As we saw during our first slide, we started the year with US 10-year bond yield at 3.9%. At that point of time, investors were expecting almost 150 basis of rate cuts. And we saw over the course of the year, those rate cut expectations of 150 basis turned to 50 basis and again have now turned to 100 basis. So interest rates can be volatile. Monetary policy cycles can be slightly unpredictable. So a moderate duration product, they provide a better risk reward over a monetary policy cycle compared to a very long duration fund in our view.
Thank you so much, Anurag. On behalf of UTI Mutual Fund, I convey our sincere thanks to our viewers for actively participating in today's webinar and asking questions. Please share your feedback in the link provided. We look forward to connecting with you in our next webinar. Remarks from Anurag, we can conclude today's webinar. Thank you. Good day.
Thanks, Sonal, for the insightful questions, and thanks everyone for participating and making it an interactive session. Hope you found the session useful. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.